trend indicator isn't one of the most popular indicators. You don't hear a lot of people speaking about it, but it is a very good indicator to build into a trading system. Now, most traders are familiar with following trends, whether tracking trends found through fundamental analysis, reading market news, or identifying chart patterns. Following trends in markets has proven itself to be time efficient. And you know the old adage, the trend is your friend? Well, it's kind of been revised. The trend is your friend till it isn't. But you should always be trading with a trend, not a trend line, but with a trend. And if you think about it, markets only have three ways to move. They can move up, they can move down, or they can move sideways, or what we call range. Most of the time, the markets are ranging. They're sideways. They're a mess. Markets are a messy place. The charts are a messy place. But when a trend occurs, and we're not talking about a trend, defining a trend as an upward move or a downward move, because price can be like this and still be moving up, but that's not a trend. It's a mess. It's as bad as being range bound. A trend is a clear movement that you can see with your eye. Okay? It doesn't have rules about it. Now, there are rules about trend lines. There's rules about general trends like higher highs and higher lows. But a trend is a upward movement, a steady upward movement. The more well-defined your trend is, the better your trading will be, the more high probability trades you'll get from it. Because if you stop to think that most of the time, the markets are completely random. They're made up of millions of people around the globe making millions of decisions. And so they're completely random. But there's certain times that the market starts exhibiting non-random behavior. When the market starts exhibiting this non-random behavior, we start seeing the beginning of a trend. And when we can see non-random behavior, we can then apply a lot of analysis because now the markets for that period of time aren't going to be random. And if we realize that a trend is a lot of work, a lot of energy being dispersed, imagine like a big wave in the ocean. A wave is a buildup of energy, okay, that as it eases down and gets closer, it's dispersing that energy. So a trend starts off with some buyers buying, whether it's you and me or something to spark the market, whatever. But it starts to spark a movement. As these buyers are jumping into the market, you don't want to be in there then. You don't care about them. They start building this momentum. It's like a locomotive pulling off the station. It's slowly building up steam, and you can see the steam coming out like an old Western movie. You see the steam coming out top of them. You hear the wheels going chug, 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 chug. And eventually, that train builds up momentum and speed. Once that train is starting to build that momentum and speed, that's when we want to start being aware. Not when it starts filling up the engine, start building steam, start chugging out the station. Because once it's built up that momentum and speed, it's very hard to stop. Can't stop on a dime. Somewhere I read once that locomotives, especially like freight cars carrying huge amounts of freight, take miles to get started moving and lots of energy. But once they get started, some of them take 6 miles to come to the stop because they have that forward locomotion. So the basic motive of the super trend indicator is to give buy and sell signals to traders. It shows the change in trends by turning its flips. when the price of an asset goes higher than the indicator value, the indicator gives a signal by turning the color green. Vice versa, when the price goes down lower than the indicator value, this signal turns red. It is shown as the color change. So the super trend indicator is very easy to read, and I'll show it to you in a second. The indicator quickly captures the short intraday trends. However, the default values of 7 and 3 are good while you use it. To reduce the parameter, you might end up generating a lot of wrong signals. So the super trend indicator looks just like this on your charts. And we're not concerned with whether it is red and green. We're concerned with the flips. When red turns to green, or if green turned to red. And I'll show it to you in a minute in a live chart. So many experts that use the super trend indicator think it's best when used in combination of things like MACD and RSI. But it's all got its own advantages and disadvantages. The super trend indicator isn't really a freestanding indicator. It is part of a support team. And I'm going to show you, I prepared a little presentation a little bit later to actually show you how you would build a trading strategy using the super trend indicator MACD and RSI and Bollinger Bands to fully interpret what the market's telling you. So the best thing about the super trend, actually, before I go on, let's go to a live chart. Okay, let me pop up a live chart. I got one ready for us. Okay, now I've already popped on the super trend indicator. Even though it's a lesser known indicator, it is popular enough that it's an automatic setup on almost every trading platform. So I went up to my indicators and I just made super trend one of my favorites and clicked on super trend. Okay. We can see that I've color coded it, I gave it, you don't have to have backgrounds. I like things that have background, but if you want something cleaner, you can take the backgrounds off of it and just have the lines. You can make them darker and thinner or darker and lighter, whatever you want to do that makes it easier for you to see it. Okay. But that's really based on the charting system. Then we go to our inputs. Okay. We want to use a factor of 3 and 10. It's the standardized definition of the standardized calculation for the super trend indicator. It's a 3 period and a 7 period, a 10 period. Now, what we're looking for on our super trend indicator is when the colors flip. And you can see it very easily because now that you put the background, you can see when it goes from red to green and green to red. Now, I've also added onto my charts MACD and RSI, because these three things work well together. Now, for instance, here we have an RSI crossover, but with no momentum, no strength. Here we have another RSI crossover. Here. The super indicator didn't flip till a little bit later. So we have a buy signal from MACD. We have RSI moving up slightly into overbought zone, but it is above the 50 line. And we need to find an entry point. First of all, we don't have a lot of conviction yet. Okay, it's not a very strong crossover, but we get the super trend indicator giving us a flip from the red to green, giving us a place telling us to enter. So we could have entered that trade somewhere along here. Okay. So what it's helped us do is define our decision whether we should go long or short, whether it should enter the market, and a point at which we should enter the market. So they combine very well together to make a complete support staff for each other. Okay. And one of the reasons that MACD and RSI are so popular is MACD and RSI respond very quick in short time frames and are very good for short-term trading. And that's why we're discussing it today. And they also adjust, all three of them, to changing your chart level. So we're looking at a 1 hour chart because this is my standard teaching chart. But if I flipped it over to a 30-minute chart, everything adjusts itself very well, and it gives us a more clearly defined view. Let's say, for instance, here we have a crossover with MACD. Which would have been a sell signal on the way across. We have a overbought sign in the RSI, but look at that, the super trend indicator didn't tell us to do anything. And look at what happened. It didn't have the supporting cast. And what happened was the market didn't continue to go up, but it moved to sideways action. So it stopped you from making a bad trade. It doesn't necessarily tell you to trade something, but it could stop and help you weed out false signals. So let's go back to my PowerPoint. Actually, let's clean up this window here. I got too much stuff on here. And let's go back to my PowerPoint. So understanding and identifying buying and selling signals in the super trend is the main crux for all intraday traders. Both the downtrend as well as the uptrends are represented by this tool. The flipping from red to green or green to red gives us these signals. A buy signal is indicated in green color, whereas a sell signal is given as a red color. Super trend indicators are characterized by the red and green lines. A green indicator represents the buy and a red the sell. You'll gauge the market's bullishness by the green line, the bearishness by the red, and determine support and resistance zones that may be used to determine the stop loss levels. Traders find that the super trend indicator works well in trending markets, but false signals are often generated when the markets move sideways. So keep that in mind. And when you're looking at a congested sideways moving market, the super trend indicator isn't reliable. Okay. So that tells you when the markets are moving that way, ignore the super trend indicator. Now, to calculate the super trend, you need to input the period, which specifies the number of days for the ATR, the number of periods. And in this case, we used a 10 period ATR. When the period is multiplied by the multiplier, then the ATR period defines the range of the asset's price used to calculate the trend line. For example, when the ATR is set at 10, the indicator analyzes the highs and lows for the last 10 days. And then combine the high and low price are divided by the value of the two. When we're looking at a 1 hour chart, we set it at 10, it's going back 10 candles, 10 time frames, not 10 days. The combined high and low prices are divided by the value of 2, from which the product of the multiplier and the ATR value is subtracted for uptrends and added for downtrends. So what do you get? For up price, for when the price has moved up, you have the high plus the low divided by 2 times the multiplier times the ATR. For down periods, you have the high plus the low divided by 2 minus the multiplier times the ATR. And the ATR calculation is the prior ATR times 13 divided times 13, which is the current ATR divided by 14. In our case, let's back it up. We're using 10. So it'll be the prior ATR times 9 times the current ATR divided by 10. The super indicator usually comes with a default setting of ATR at 10 and a multiplier of 3. For different assets, there is no single best parameter to use. The ATR observed when depending on the asset and the period watched during intraday trading. Now, what's unique about being able to set your ATR and your multiplier is you shouldn't change it hour by hour, day by day, week by week. But you might find that if you're trading commodities and you're trading primarily in using 15-minute and 1 hour and 30-minute charts, you might find that maybe you're better off with a shorter period and a larger multiplier. But that would then be standardized for all of those assets in that class that you're trading in. It's not individually associated and changed on a routine basis. So lowering the parameter of the super trend indicator increases the number of buy and sell signals. Most traders find themselves lowering the parameters when they want faster signals. However, lowering the parameters also increases the number of false signals, otherwise known as whipsaw, making confirming trends with other indicators like MACD and RSI almost essential. So again, what are the best setting in the parameters? Okay, we talked about the multiplier 3 and 10. Now, based on the wave principle, the super trend indicator works to predict movements of price. It consists of different indicators that are used to identify price movements. By monitoring these indicators regularly, one can easily find support and resistance levels that are likely to be broken or violated and take advantage of this buying at support and selling at resistance. Support levels refer to the price level where the asset gets sold off after hitting a high period, and resistance refer to a point where the asset hits a low point but starts moving upward once it again dropping from a specific level. Similarly, if prices remain below a certain resistance level, it should be considered a sign for investors not to acquire any positions, since the downward trend will continue for some time and might even increase losses if losses have already started occurring. So one of the simplest ways to identify buy and sell signals with the super trend indicators to plot them on the chart and look for the entry and exit indicators based on the color switch. Combining indicators is an essential step that helps traders weed out false signals. So I'm going to share with you, run for you, this presentation I built of combining the super trend indicator with other indicators to build a trading system and how to use it to analyze it. But it had to be done in a pre-recorded method because there's too many things going on, and I needed the charts to be relatively stable. So let me share that with you, and then we'll come back and talk about this a bit longer.
Indicator 1, RSI. The Relative Strength Index compares the magnitude of recent gains to recent losses in an attempt to determine overbought and oversold conditions of an instrument. As you can see from the chart, the RSI ranges from 0 to 100. An instrument is deemed to be overbought once the RSI approaches the 70 level, meaning that it may be getting overvalued and is a good candidate for a pullback or reversal. Likewise, if the RSI approaches 30, it is an indication that the instrument may be getting oversold and therefore likely to reverse. Traders will often use the RSI either coming back out of its overbought or oversold areas as a signal or partial signal to enter a trade. As we can see, the RSI is often accurate when indicating when a market will reverse. A trader using RSI should be aware that large rallies and drops in the price of an instrument will affect the RSI by potentially creating false buy or sell signals. Traders often combine the RSI with other indicator signals, such as MACD crosses. Indicator 2, MACD. The Moving Average Convergence Divergence is one of the most well-known and used indicators in technical analysis. This indicator is made up of two exponential moving averages, which help measure momentum in an instrument. These moving averages and the changing distances between them become the MACD. Convergence simply means the moving averages are moving closer together, and divergence simply means they are moving away from one another. When the shorter-term moving average is above the longer-term moving average, this area of the indicator will show activity. When the shorter-term moving average is below the longer-term moving average, this area of the indicator will show activity. The center line, of which the MACD is plotted around, indicates where the moving averages are equal, and when the MACD passes through the center line, this indicates the moving average is crossing. The signal line, here in red, is a moving average of the MACD values themselves. Typical values for the MACD are 26 and 12 exponential moving averages, and 9 for the signal line. The farther apart the moving average is, and the greater the momentum, the farther away the MACD will be from the center line. Traders use MACD and signal line crosses, such as these, to indicate momentum trades. You can see how these crosses often match up with market moves. Traders also use the MACD crosses to indicate when momentum is coming out of the market, and may use it as a signal to exit a trade. Indicator 3. Bollinger Bands. A Bollinger Band starts off with a simple moving average. It then has two standard deviations plotted away from it. That sounds a mouthful, but the important part is because standard deviation is a measure of volatility, Bollinger Bands adjust themselves to current market conditions. When the markets become more volatile, the bands widen, move further away from the average, and during less volatile periods, the bands contract, moving closer to the average. The tightening of the bands is often used by technical traders as an early indication that volatility is about to rapidly increase, as volatility often follows periods of lack of volatility. The markets spend most of their time within the bands, and when the price action reaches the edge of the bands, it is often more likely to reverse and come back into the range. This is used as a signal by reversal traders to take a trade. This is similar to the oversold and overbought conditions of the RSI. Indicator 4. Supertrend Indicator. The supertrend indicator is an excellent indicator of trend direction. It can be used as a foundation of a trading system that is based on trend following. One of the most popular ways to use this indicator is to enter the market after a pullback. For example, if the market is on a downtrend, indicated by red, wait for a green pullback and then re-enter the market once it turns red again. The same can apply in uptrending markets. Here we can see how this indicator accurately tracks market trends. It can be refined through the settings to match the specific instrument. Indicator 5. Confluence. The last indicator isn't a new one, it's indicator confluence, which means to use multiple indicators and their signals to take a trade. Here we have the RSI and MACD we looked at. We have the RSI moving into overbought territory here. Remember that indicates the market will reverse. However, we want to help us filter out false signals on the RSI, so we also look at the MACD to give us confluence. We can see it is indicating the momentum has come out of the market, as far as the market rallying or going up is concerned, and we have an MACD cross here. A signal to enter this short trade could be waiting for the RSI to come back out of the overbought and also waiting for the MACD cross. We can see that those combined signals are an indication that captures this trend. You can also use the opposite signals to indicate when the momentum is coming out of the market and it's more likely to reverse and the market to retrace back up the opposite direction of our trade, and therefore is an exit signal. In addition to the RSI and MACD signals, we can add further confluence to this trade with a Bollinger Band and the Supertrend Indicator. We can see the market has hit the top of the Bollinger Band here, but we could also wait for the Supertrend Indicator to change red here before taking the short trade. So now we have the confluence of four indications. We have an RSI coming back out of overbought, we have an MACD cross, we have the market going to the edge of one of the deviations on the Bollinger Band, and we also have the Supertrend turning back to red.
So there we had a nice little easy explanation of how to use confluence as well as using the four different indicators to make a strategy and make a trading system. So a great way to determine entry and exit points for your trade is to combine the RSI indicator with the Supertrend indicator. Measure the momentum of your potential trade by observing whether it's overbought or oversold by using the RSI and its default period of 14. So as you can see on my chart here, we've combined the first two of these indicators together. An RSI value below 30 typically indicates the market's oversold, with most traders accepting the price crossing 30 to be a buy signal. An RSI value above 70 usually indicates an overbought situation. So using the super trend indicator combined with RSI indicator eliminates many whipsaws while generating more accurate buy and sell signals in moving markets. You can apply the RSI indicator with a length of 7 to a 5, 10, or 15-minute chart. We can also combine that with the MACD, and combining the super trend indicator with the MACD indicator's ability to measure trend strength is a useful technique for building a strategy. Just like the super trend indicator, the MACD works best in trending markets. Uptrends are also indicated by the MACD crossing above the zero line, which traders recognize as a buy signal. Downtrends are indicated by MACD crossing below the trading signals. The recommended day trading parameters for a MACD indicator is a 26, 13, and 9 on a 10-minute chart, varying based on periods observed. It can be any period that traders prefer relative to the duration and number of candles it represents. Traders will notice convergence happening as the histogram gets smaller when the moving average approaches each other's value. So when they cross over, a new trend is indicated. And if the faster moving average crosses under the slower moving average, there's a new downtrend. We can combine these together into one great trading strategy. So the super trend is an interesting indicator in trending markets, although it might be a lagging indicator because it depends on existing price action. It's highly recommended to use other indicators to confirm signals. So for example, RSI and MACD are good indicators to confirm the current trend and assess if the trend will sustain. When used in combination with other signals, the indicator can be used more reliably. So the bottom line is the super trend indicator is one of the quickest technical analysis tools, and it takes very little technical knowledge to implement successfully. Using multiple indicators and combining super trend with other overlays will help to decrease the chances of false signals. Traders are advised to test out various parameters and indicator combinations to identify profitable entry and exit points. So thank you very much for joining us tonight. Thank you for being part of the Alvexo family, and we'll talk to you again next week. And good luck out there with your trading. Bye now.